Building the new digital factory of finance. Now, the person I'm going to introduce as the moderator probably doesn't need introductions. So I'm just going to tell you what I think, right? If I was starting any business in this sector, the person I would speak to is David Wachsman. Why? Well, it says like PR on his company. He's so much more than that. Please welcome David Wachsman to the stage.
Hey everybody, we've got a fantastic panel here today. We're going to be talking about the future state of finance, how we get there, and what's missing from what exists today. Greg Carson, XBTO, JB, Bitstamp, Carlos, Securitize, and Morgan from Provenance. All right, everyone, first question. 5 years from now, what does finance, the financial industry, we're not talking about just crypto, financial industry have that it doesn't have today? What's the big change? Anyone can answer. Who's up first?
I can go first.
Okay, Carlos.
I think if you look at what has happened the last 20 years and what has not happened, is one of the things is that accessibility to public markets has increased dramatically, and that has benefited everybody: investors, companies, capital markets, capital formation, trading volumes, etc. And the next, let's say 5-10 years, I think a similar type of revolution will happen on private capital markets. Yeah. Because private capital markets are the opposite. They are not digitized, they are inaccessible, they are not, they perform very well, but...
And when you say accessibility in private capital markets, are you referring to equity shares being more purchasable in foreign countries? Are you talking about widening the percentage of people in general beyond accredited investors, perhaps? What do you mean?
Yeah, well, even accredited investors today don't really access private capital markets. It's the realm of institutional investors. So just only making the leap into accredited investors, which in the US is more than 10% of the households, that will be a major progress. And regulators move slowly, and that will require to introduce regulatory changes. So I think that, yes, accessibility to individual investors versus just institutions.
Yeah, I could add to that. I think our thesis is that the whole opportunity, especially like from a venture capital standpoint, is that it's an order of magnitude bigger opportunity than previous technology boom. Like you had the consumer markets transformation, you had the business and SaaS transformation. Now we have financial markets transformation, and that's like the people on this stage.
What does that mean? What is that going to mean?
I think it means all the things Carlos said, agreed, and then also all the technology that needs to be in place for what used to be Wall Street to move to 24/7 trading, tokenization of various things, digitization of things, securitized debt coming on chain, other assets coming on chain, stable coins becoming more integrated. Just all the startups that are going to exist because the banks and the financial institutions can't innovate, or they can't innovate fast enough.
Maybe just what I would add, we think over the next 5 to 10 years, this is really finance's internet moment. That's how I would say it from a financial services background perspective. Yeah. What that means is we can finally re-architect the infrastructure layer of finance, meaning how finance works. So the last decade has been about innovation at the consumer app layer, but that's riding on all the old rails and all the old ways of doing finance. The new digital factory of finance is natively issuing financial assets, all types of financial assets, and we totally agree with the private assets being a huge space. On-chain, paid for with digital money, issued by banks, we think in large part, to create materially efficiency by stripping away intermediation. All of financial services today is basically intermediated trust. The cost of intermediation is very high when you have an alternative, which basically means you can issue an asset natively on-chain and then do the range of activities, whether that's servicing the asset, financing the asset, trading the asset, securitizing the asset, all can happen much more efficiently, and you can drop the cost to serve.
Okay, so let's kind of unpack what you just said, because I think there's a lot there. As you heard earlier, I'm a fan of history, reading a book right now by a Pulitzer Prize-winning novelist, and he very carefully kind of picks apart all the things that eventually led to the Spanish flu, World War I, and of course kind of a new world order that emerged afterwards. In the same vein, I want to talk a little bit about the plumbing that you were referring to earlier that needs to be replaced. What about the financial services sector today has plumbing that's made out of lead, that's poisoning people, that we don't know about? What's the thing that really does fundamentally need to be replaced? JB.
Yeah, so I would say we have been in a crypto space for more than 10 years with Bitstamp. So when we started the crypto exchange, there was no regulation. It was really the early days of crypto. There was simply no regulation. So what we tried to do at the time, is to become regulated. So we went to many countries, for instance, in Europe, knocked the doors to the regulators to say, well, can you regulate crypto? The only country where we found a place was Luxembourg, back in 2015. What we need to do now is to build, a level playing field, across the different regions, so that we have a proper regulatory framework to enable access to crypto, so that we have, I would say, regulated and compliant and secure players. Because what we have seen in the last couple of months or quarters, regulation in fact matters, and security matters. So I think the last 10 years have been like trying to build a regulatory framework, but the next 10 years should be, to have this level playing field, smart and strong regulation, so that we can build, I would say, high level of consumer protection to allow and enable the adoption of,
So you would say that regulation is one of those things that needs to be improved in some manner. Is that what you're saying?
Yeah, I think regulation will enable more consumer protection, which will trigger some adoption into the ecosystem to rebuild the trust that potentially we might have impacted over the last quarters. Yeah.
Carlos, you started Securitize. I remember this very well, in part because I tried to introduce you to someone who could help you tokenize a security, and it turned out that company didn't really exist. They didn't have a product, and eventually you started this organization. I want to go back to this theme of plumbing that needs to be replaced. Tell us a little bit about why what Securitize is working on didn't exist previously.
So if you look at why capital markets in general are inefficient, whether they're public or private, is for two particular reasons. One is that there is no reliable, publicly accessible way to know who is the beneficial owner of something. I mean, you believe it or not, but if we buy Apple shares, very few people know that you actually own those Apple shares, and Apple doesn't even know that you actually own Apple shares. So simple things like paying a dividend is a total nightmare that takes a month for you to get your money because they just don't know that you hold this.
This is a really good concrete example of something that sucks.
Yes, very specific. And for private markets, it's even worse because there is not even any ledger or anything where you actually track ownership. So fundamentally, this is one of the pieces of infrastructure that public blockchains solve, right? Because it gives you a trust, shared public ledger where you can efficiently record ownership of something. So that's the fundamental piece of infrastructure. Once it gets adopted, enables a ton of different things that today are inefficient. And the second one is that the other reason capital markets are inefficient is because where the securities get tracked and the ledger for securities and the ledger for cash are separated. And you have to make sure that if I send you security, you send me cash, and this settlement thing is a big thing that becomes very complicated. And
it takes several days.
Takes several days. It could take weeks, depending if they're private securities. It's 2 days in public securities. There is errors, etc. So the fact that you have this public shared, ledger that you can trust, that you can represent securities, and you can represent cash with digital currencies, which I agree. Somebody said this morning, stable coins a terrible name. I think it's a terrible name. The dollar is not stable. It just fluctuated 30% with the euro. It's a digital currency, right, that you actually can represent on the same ledger with the same technology, and that you can swap them in an efficient way. And
so things can happen much faster.
So only those two things, provenance of an asset in a reliable way, which enables things like lending, stuff like that, which is difficult because you can't trust whether somebody owns the collateral or not, as well as having the cash represented with the same technology in the same ledger to be able to swap them efficiently. Only those two things are the foundation for everything else that is inefficient today, and a lot of other applications that today do not exist in financial services that will come once this is adopted.
So Morgan, you left a very successful career in TradFi for a reason. Tell us why.
I do really think that this is a once-in-a-generation opportunity to change how finance works in a lot of different ways, and making private assets more operationally easy to issue, making it ownership very clear, offering secondary liquidity, trading opportunities. Putting lending on, and Apollo is in the room, who's put funds on chain, their digital asset fund on chain as an example, right? And a lot of large issuers have put funds on chain, on Provenance. I think this is going to take trillions of dollars of market cap out of the system from intermediaries. There's intermediaries in every transaction. If you think about lending, even a mortgage, if we talk about high friction markets, right? This is 45 days to get a mortgage. And it's extraordinarily expensive. If you put a mortgage on a blockchain, which we have live, you basically can issue it in under 5 days, as an example, right? And once you natively put that mortgage on chain, and it's an e-note format, as an example, all the origination to distribute becomes a lot more efficient. So you can programmatically distribute that asset, which is what finance is about. A lot of it is risk transferal. So you can see in real time the repayment status of all the mortgages in the portfolio. So you can basically originate to distribute. So Figure has $300 million of home equity lines of credit on Provenance today a month originating. So, and you can get a HELOC in a 5-minute process online and get it fully funded in your account in a few days. These are material benefits for the consumer. You can offer a lower interest rate because the mortgage is cheaper to originate while the originator earns more money. So you're really stripping out trillions of dollars. And then you go to interchange. When you get digital money on chain, you won't need to go through Visa rails and merchant issuing processor, et cetera. If you go in infrastructure space, there's a $20 trillion funding gap in infrastructure, as an example.
So, as you were saying, mortgages are already beginning to go on chain.
Yes.
But some of it's not yet built. There are these grave inefficiencies.
Yeah.
And so you're an expert on stablecoins, as it turns out.
I don't know about if I'm an expert.
Well, I'd say so.
But
you talk a lot about kind of the digitization of things before it turns into tokenization. But stablecoins are one of the first kind of use cases of something that's in the real world digitized, tokenized, and made incredibly useful. So kind of what's the next step for stablecoins?
Yeah, I think it kind of dovetails with the stable coins and the concept that there's this whole old world TradFi world out there, trillions of dollars of loans, not just mortgage, structured credit, the debt capital markets, all these things. And stable coins it's kind of like two sides. Native stablecoin integration to the platforms means, that the institutions can trade more easily, the people can trade more easily. The other part of it is that we have all these legacy assets, like trillions and trillions of dollars of legacy assets, like a debt portfolio or a credit desk or equities or whatever. And there's an intermediate step that I was kind of conceptualizing, we were talking before, which is I think that there's a step where a lot of that stuff has to get digitized before it can get tokenized. It's easy if we go straight to a blockchain, perhaps, and I have other questions about that. But in the intermediate step, there's just all the traditional intermediaries that are, they need some sort of tool. Like we invested in a company called Namu21. It's an AI tool that can digitize an entire structured credit portfolio in like 5 minutes. And then all of a sudden...
And so these are not digitized today? I mean, I'd imagine they're existing on some digital ledger of some sort. Maybe it's Microsoft Excel. They're
PDF and Excel. I mean, even in some of the biggest funds, they'll have, maybe they'll have some custom tool they've made, but it's not interoperable with the rest of the walled garden. So Namu's partnering with Goldman and JP Morgan and a few of the banks to make a walled garden where they can...
So let's say it is digitized, and let's say eventually it's even tokenized.
Yeah.
What does that mean? What fundamental change is going to occur as a result of that? Like, is this going to make it more accessible?
Yeah.
Is it going to drive down prices? That's what I'm trying to understand.
Anomalies will be more identifiable. Secondary markets will open up. Liquidity will be able to flood in more. I mean, right now, liquidity is held hostage by the intermediaries. That's what the banks are. They basically hold liquidity on their side and then they release it. If you can drop those assets into one of their markets or another marketplace, all of a sudden you might have 100 loans, you want to sell 4 of them. Right now you can't really do it efficiently. But soon you'll be able to either have NFTs or have portfolios that are tokenized.
So is this something that Bitstamp, you're the CEO of a major crypto exchange, but I would call it really a digital asset exchange first. Have you been thinking about the future where your trading on your platform are available much more than spot cryptocurrencies?
Yeah, I think the trend we are experiencing at the moment is that there are so many initiatives on tokenization, tokenization of watches, wine, real estate, you name it. And I think, traditionally, we have been offering crypto assets, digital assets on our exchange. So we have the technology to list much more, than just the current digital assets. And I think there is the appetite for that, first from Bitstamp, we have the appetite to offer much more than crypto traditional assets to our clients. But at the same time, we see a very, very positive trend in the ecosystem where security or tokenization needs a venue, where they can list the security tokens or the tokens. And I think, with powerful regulation plus our technology, we can onboard much more than just digital assets onto our platform. And I think to the question, how do we see the next 10 years? I think Bitstamp as a venue, we see probably what we are doing today since 10 years, but on the top of it, definitely, we should be in a position to offer security tokens or tokens as soon as we have the proper licenses. Today we have 50 licenses. We can offer what we can offer, but it's not good enough. You know, we need to go a little bit deeper. And I think the next 10 years for us, that's probably a little bit of, you know, a pivot where we can offer much more than digital assets, the one that we are offering today on the platform.
So can some of this take place? I'm hearing some kind of, well, very, very either high frequency or high volume sets of data that we're talking about here that are going to be digitized. The data sets are going to be huge. The reason I'm posing this or bringing this up is I'm wondering if the infrastructure we have today is sufficient. I know that banks, for example, have done much of their work thus far using private blockchains, which are essentially distributed databases, right? That's what they've been building off of so far. Morgan, is public blockchain good enough?
I think, yes, we're proudly public at Provenance. We're part of the Cosmos ecosystem, but code changes are governed by the community, right? So I think you apply risk management just in a different way through tokenomics. You can encourage your validators to be KYC'd through delegation of hash so that they can earn more money on chain, as an example. So I think for me, the future long-term state, if you fast forward 10 years, is absolutely public. Open innovation is critical. There's 1,500 Cosmos developers building out the overall Cosmos framework. We decide what we import into our chain specifically built for regulated institutional financial services. So I think permission, there's not enough juice in permissioned, in my humble opinion, to warrant the pain and effort it takes to implement blockchain. It's just, you know, basically replicating what we have today, which is a permissioned system for financial services. So I think we might have to move through private and permissioned for certain asset classes like digital money. So we're establishing a private permission zone for USDF, which is bank minted tokenized deposits, to meet regulatory education required around getting them comfortable about governance.
Wait, tell us more about that for a moment. Bank minted US deposits?
Yeah, so in our view, and again, I'm a payments girl at Citi around the world, and a lot of the blockchain projects I worked on were in payment space. From my point of view, to have blockchain work for financial services, you have to have fiat money on chain, and that should be predominantly issued by banks. Banks have the balance sheet, they have the reg framework, they have the risk management, they have the customer relationships. And they're a big part of the economy. They're a big part of the outstanding circulating currency. So banks, all of the stablecoin legislation should encourage banks to be able to mint because of the existing framework. So USDF is bank minted tokenized deposits. There's 9 banks that are part of consortium today, growing, et cetera. So our view, banks have to be part of the digital money fiat on chain for this whole thing to work.
Carlos.
No, you asked before, like, what does tokenization mean? And I just want to answer with a similar. So in the world of innovation, there's 2 types of innovation. There's incremental innovation, where you improve something that already exists, and disruptive innovation, where there's new stuff that happens, right? So if I think about some of the use cases that people are working on, and this is what, especially large financial institutions, they tend to try to focus on improving what they already do rather than creating new stuff. So some things like, you mentioned improving how mortgages are done. This is great, and it's going to be...
It's a big deal.
It's a big deal, but at the same time, I can get a mortgage anytime I want. I just got 1-2 years ago, right? While there is stuff that doesn't exist today. Like, for instance, if I actually want to borrow against certain asset classes today, the lending market doesn't exist. And why it doesn't exist? Well, it doesn't exist because, first, they don't know how to prove the provenance of the...
Can you just give us an example? Just
an example, like we're working with KKR on tokenizing some of their funds. And today, that fund, when it was distributed in traditional way, was distributed primarily by wirehouses like Morgan Stanley, right? And Morgan Stanley would actually not lend you against a KKR fund, even though it's a private equity fund with very good performance, etc. Why not? Well, because they don't, it's too cumbersome to bother for the return. But if you take that, KKR fund that you bought...
So let's say I just want to make sure I understand this. In this case, I'm an LP or something like that of KKR, and is this for them, or who benefits here is what I'm trying to understand here.
So people that today, if you're a very large LP, like millions and millions of dollars, they'll do whatever. But if you're, let's say, an individual investor that bought $250,000 through Morgan Stanley, KKR will not even talk to you. They don't even know you exist.
So I can't use that asset as collateral.
And why not? Well, because it's too cumbersome to do it. And if you go to other banks, the other banks cannot actually prove the provenance of the asset because they don't know whether you actually purchased with Morgan Stanley or not. If you were, let's say you go to JP Morgan, and they also don't have a simple way of, ceasing locking your collateral, so it's not rehypothecated with somebody else. And then if you default the loan, they don't have a simple way to take the collateral in, right? So tokenization actually fixes that in a very elegant way, right? You buy the KKR fund from us, you get a token. That token is issued on a public blockchain that is an irrevocable proof of ownership on the fund. If you go to a lender and deposit that on a smart contract and get USDC, which already exists and as a stable coin, then the token is kept by the smart contract until you return the loan. If you don't return the loan, they can move the token to their own wallet, etc. So everything.
This can create a new class. If
Correct.
I'm reading
That's my
this right.
thing. So that's what the exciting things, right? Like new stuff. It's like when when the computers started, you had the mainframes, right? So people were building faster mainframes, and then somebody called Steve Jobs came up and built the Macintosh, right? And that actually opened up access to computers to people that didn't have access to computers. And that was revolutionary, not building a faster mainframe. So I think that as an industry, we need to be focusing on those use cases, because those are the ones that are really going to create new financial services products in a more accessible way that today they don't exist.
So I want to just follow up on that, and I can ask you, Greg, actually, if you can answer this question. Let's say the future state exists where I can go and take my private equity investment and use it as collateral to go get a loan because, I don't know, right now interest rates are high. So I decided I want to do that. Let's just use that as an example. What's missing? Because right now, what's missing today for a future for that to exist? That is to say, is there simply not perception of this? Is the tooling not built yet, Greg? You invest in these types of companies.
Well, I think I like what he said, because I think this is low-hanging fruit for our industry right now, is the private equity funds and that kind of stuff. But the real power is going to be when we can get this, like to the masses essentially, or even past accredited venture. We have two companies. One is Credora, which is a ZK credit system, so you can actually get credit scoring based on like digital asset portfolios, and they can lock it up and do like cross margining. And the other one we're about to do a seed, which is it's called Juice, actually, as she said earlier. But and they're going to do a whole 100% collateralized lending platform, so they can basically, if you have an asset, if it's on their platform or any other platform, or it's on either institutional or accredited, you can actually lend and borrow against that in a collateral. So I think collateralization and all this credit stuff is a huge, huge opportunity for all of us. And there's maybe 20 more companies that we can talk about that will benefit. They're leading the way with really with the hatchet in the jungle, like clearing the way with regulatory and doing use cases. And I think it's going to benefit a lot of our portfolio companies.
I'll give you another example. So yesterday we were having dinner with a bunch of friends here. And then, the restaurant we went, they don't have any efficient way to raise money from the customers. It just doesn't exist, right? Like, what are they going to do? So it's not a simple way for them to access capital markets, which is to raise money from investors. And the customers of the restaurants are the most likely investors because they go to the restaurant because they like it, right? So, and imagine a world where I have a QR code on my table and I'm having dinner with my friends and I like the restaurant. I can open up my, crypto wallet, and my crypto wallet, has some sort of on-chain KYC, so they know who I am, and it's done with privacy preserving, etc. And then I just scan that QR code. Instead of giving them a tip, I send them 100 USDC, and then they send me a token that represents equity on the restaurant. And on top of that, they can actually prove I'm an owner, so they can actually give me a discount that they will not give it to other people because I'm actually part of the equity, and I can prove the provenance of the equity because I have the token on my wallet. And if for any reason I sell it or give it to somebody else, then
let's actually slow down on that too, because I want to ask a question that's really fundamental to this. That sounds like a fantastic use case yet again. Who here wouldn't want to invest in their favorite restaurants? Maybe they open up a little closer to you or in a different location, something like that. But the real question here is, do we need a blockchain for this? Does this actually need to be tokenized? Morgan.
I think yes. So I think tokenization enables. I'm a digital done right delights person, right? And the done right is important. And when you're born digital, and for me that means born on blockchain, then everything else downstream. This is a new assembly line of finance, the new factory of finance. You got to start digital, and I agree with Carlos. It opens up new opportunities, for distressed asset ownership and trading, as an example. For infrastructure, there's a $13 trillion funding gap in infrastructure. If you can tokenize the exposure to these are bridge, roads, power plants, right? And only banks can finance that today. But if you can issue a token that represents the cash flows of that high returning asset, that's low probability of default, to investors, like pension funds and insurance companies that want to hold long-dated exposures, you can attack that funding gap and you can broaden access to that asset class. By the way, you can tell people, oh, if you're interested in clean energy, you can pull out a specialized asset token that only gives you exposure to that power plant because that's your specialty kind of thing. You just can't do that in traditional finance the way it's architected today. You just can't create those products. I disagree with Carlos in that the existing financial services, there's so much pain and suffering in terms of cost. So, I think the only way blockchain becomes mainstream is if TradFi adopts it. And some of the missing pieces, I think, we talked about digital money on chain. Trust of public chains, we have to build that out. Regulators are, the US regulators just issued a week ago, they don't believe you can do quality banking business on public chains. And, so I think...
We've seen US senators ask if we could pause crypto for 6 months. Just pause it.
So, there's a big education gap. And then, we're still in early, I think I would call 2022 institutional adoption of core business use cases, not fringe, not POC. But there still needs to be a lot of maturation in the layers of the new financial cake and how that's going to bake on the digital asset side, on the digital money side, digital identity side, digital security, and networks and chains. Each of those have to keep maturing. You asked a while ago what needs to improve. A lot of that, and then that regulatory framework that gives confidence about the guardrails. So I'd just say a lot of pieces within each of those layers need to improve. Digital identity.
So why you need a blockchain? So this you actually don't need what you need is some sort of open internet protocol that allows you to transact with things that represent ownership and value, right?
And just so happens,
that's not a digital replica.
That sounds like a blockchain to me.
So I need to be able to represent ownership of something in a public ledger, right? Because otherwise, all these use cases don't work if they're closed ecosystem where you could use a database, for example, but then it misses the point of being able to replicate this across the ecosystem, being able to have the same digital cash representation in this phone that works across all these different restaurants, that somebody can open a secondary market trading for all these like micro stocks and do it efficiently, sharing the data. So yeah, you can always build things with traditional technology, but this technology enables an open ecosystem that this is where innovation will come, right? So
I'm always skeptical of blockchain for everything, or blockchain is working for everything. And I think that there's still a maturation we have to reach. I don't know if there's any blockchain that is, proven secure and proven to has already gone through all this state-based actor hacks and.
Well,
Ethereum,
you will argue.
Bitcoin for sure, maybe is
Ethereum
the
is
longest.
Since 2015. It's never stopped. It's never been hacked.
Right.
So.
Well, it has forked.
It has forked.
Yeah, it has forked. That's a different problem.
Yeah,
but that's it's a decision of the community, right? It's not a bad actor forcing that.
But it's now proof of stake, so it has other regulatory concerns, and proof of stake also brings other decentralized questions on how they're how we might
staking securities.
All right,
and also a concentration of power and that kind of stuff. Whereas, so it always pops into my head okay, is blockchain the right thing? Maybe it's the right thing, but it's a blockchain that's already withstand the test of time, already fended off the hackers, already distributed in different countries.
Well, so hold on, guys.
Right?
I'm going to shift the conversation just a little bit because I think we've made a very strong case here. I should say you've made a very strong case here that we must need blockchain for the plumbing to be ripped up and pulled out of traditional finance. Let's talk a little about crypto finance because this is the future state isn't just doing mortgages on chain just because it's more efficient. It also means perhaps because people seem to want, so it seems, digital assets. They want Bitcoin, they want Ethereum, they want to make use of these things. Exchanges sit at the very heart of the industry. What needs to improve that isn't built yet for digital asset exchanges to better serve customers in buying, selling, and trading digital assets?
I think that there are a couple of components there. I think the first one is, as mentioned earlier, is the regulatory landscape. We need to have a proper regulatory landscape whereby we can list security tokens, for instance, on our exchange or on other exchanges. So there is an element of regulatory. There is another element which is on a custody as well. New tokens, new security tokens. It means that we have to develop, custody solution to accommodate new project, new tokens, for instance. Whereby, is it, ERC, is it, another token? But custody is very key here, to make it very, very successful. The third thing I would say is what we are experiencing with Bitstamp is a huge appetite, from institutional players in the industry to go into the tokenization. And what we need to do there is to work with the institutional players, with the custody, with the, I would say, those initiatives, really to try to work together and to make them happen. But I think the critical...
So what I want to ask how Bitstamp helps. Like, for example, are you helping them tokenize corporate debt? That's what I'm trying to understand.
So at the moment, we can offer, digital assets onto the platform, which are not considered as being, securities, which means that today we are offering, a number of crypto assets. In the future, what we would like to do there is to be regulated in a manner where we can offer much more than what we are offering today, which means new licenses, new partnerships with custody so that we can accommodate, the project and work very closely with institutional players, which are really, investing and very, very interesting in the tokenization space as we speak. But today, we don't have the weapons to do it. Maybe in 1 year, maybe in 2 years, but that's what we are developing at the moment. Yeah.
I think there's the interesting thing that just happened, which is, there's actually kind of two worlds out there. There's the totally regulated world, and there's the in between regulated world, like Binance and Deribit, and they're following all the rules they can, but they're not in these jurisdictions. And I think everyone looks at this, the FTX debacle and the proof of reserves that all the exchanges are doing now, which is a great step. That, if you think about it, is the silver lining of this disastrous year, which is that we've put to fire all these exchanges and all this technology. And now all Bitstamp and Binance and all the exchanges have to innovate because the regulators aren't going to be fast enough. So what I think we're going to see is by the end of this year, probably going to have a hybrid custodian model where some exchanges will let you hold your own assets in a wallet that you control, and you're only releasing it during trades, and then it's put back into the wallet like a...
So it's something akin to DEXs? Carlos?
I agree and disagree. Look, and this is a very crypto core crowd, so this is not going to go very well. But I think that this narrative in crypto that, there's no regulation, we don't know what to do, is not true to some extent, because there is a lot of regulation that not people in this room necessarily, but a lot of crypto companies, they just ignore and they go with it. And the simplest one is lending, right? So, there's 3 companies that went down on the lending space.
I can bring up
Coinbase, which is a publicly traded company, was explicitly said by the SEC that, lending is illegal unless you treat it as a security or you're registered as a bank, and that's it. And Coinbase, rightly so, even though they complained, they actually decided not to launch the product, which is a good thing because Coinbase will have attracted more deposits than any of the smaller players. And then BlockFi was fined with $100 million for illegally, offering lending products to retail customers. In spite of that, people continue doing it. There is no lack of regulatory clarity on that. What those companies were doing is illegal, and they opted to continue doing it because they thought that they could play regulatory arbitrage. That by the time the regulators came,
okay. So let me ask then a question from this. Okay, there have been bad actors, mistakes were made. There's no question about that. But for consumer lending of Bitcoin and cryptocurrencies to exist, is there anything that we're not doing, we as an industry, that we should be doing? Is there a way to do it right? Because it seems like there's demand, or at least historically has been demand for it. And I'm asking you guys because you are fintech pioneers and native in crypto. And I'm asking you, is there a solution here so that the next Voyager, BlockFi, et cetera, doesn't sink?
In the US, it's very clear. So if you want to do lending of any asset, you have to, for the most part, especially if it's an asset that's considered a currency, you have to become, if you take deposits and generate yields.
You be a bank.
You have to be a bank,
right?
Or
let's say
offer
you are
it as a security.
Okay, so let's say you are a bank.
Or offer it as a security.
I'm asking you, is there a technical hurdle that needs to be overcome of some sort? Or beyond simply saying I'm a bank, let's say you are a bank.
Anchorage does it in the US, it's a bank. Anchorage, we had a fund with USDC yield fund that was doing lending on the back, and we always use Anchorage because Anchorage is a bank and had all the legal licenses to do it.
And as a result of I'm saying it's one thing to be legally permitted to do something. It's another thing to do it right.
Can I just jump in on this one? I think I agreed with Greg about collateralizing lending better. And I think there are technological solutions that allow you to do that beyond sort of the regulatory framework. One thing we have in motion is this thing called DART, Digital Asset Registry Technologies. And basically what it does is if you've extended a loan, you basically use DART to transfer the lien, right? So that you basically, if I buy a loan off Carlos, I'm assuming the risk. If the person who's borrowing from me now doesn't pay me back, I want access to their collateral, and I want perfection of ownership. So our view is things like BlockFi wouldn't have happened if you could have perfected that collateral with something like a DART, which basically tracks the motion of a loan and electronically transfers the underlying ownership of the collateral to the new owner of the loan.
As opposed to right now there being multiple intermediaries where everything from a court to, I don't know, mail delays could come up.
Exactly.
I mean, BlockFi would not have happened, just to be clear, because BlockFi was doing uncollateralized loans. They were also investing in businesses that had nothing to do. You know, Celsius set up a mining operation to generate a yield. They were not just lending on the back to generate the yields. These things would not have happened if they had the proper disclosures and people knew what they were doing with their money, which nobody knew. And if you set it as a security or if you're a bank, you have certain either restrictions as a bank or disclosures you have to do about what you do with the customer deposits, which these companies did all sort of crazy stuff that nobody knew. And this is why they ended up collapsing. So.
There's clearly demand for almost every flavor product and collateralization and lending.
Yeah, and crypto, by the way, crypto as a speculative trading asset class, which is for the most part what most people do in crypto today, it requires lending, right? Because people need to get leverage. So lending now dies temporarily.
Has Bitstamp offered lending?
So directly, we don't offer lending. We work with a partner doing lending activities, for instance, in Europe. They are regulated. And I think the situation where we are today...
And how has their performance been during the difficulties?
We are launching the product as we speak. So let's put in a couple of months, we will have better performance overview. I think the key point here is that, as mentioned a bit earlier, is that every country has its own approach on regulation, and this is becoming very complex, specifically for crypto players, because the UK has a different approach from Germany, for instance, which is different from the US. So us, I would say, as a crypto exchange, as a crypto player, we are really pushing for a level playing field around regulation, where there is clarity, where the requirements are the same across the region at least. And I give you a very concrete example, like in the UK, for instance. If you are a crypto player in the UK, if you want to offer staking, you have to be regulated. Otherwise, you have to remove the product from the platform. If you go to Germany, it's very different. So this is really what we are trying to push as an exchange or as a crypto player, is consistency, level playing field, smart regulation. As soon as we have a smart regulation, I think that will help to build consumer protection and really unlock opportunities in the ecosystem, which will enable a massive adoption. So that's really what we are pushing.
We only have a few minutes left. Yeah. And I want to, because the room here is full of investors, including those from very traditional finance. If you were in their shoes, what's the type of thing that's worth investing in today that's going to become core infrastructure for the finance factories of tomorrow? Morgan.
I do agree that custody is a key part of the.
And let's keep these answers brief.
Yes, custody. We have a utility token called Hash, and we have institutional ownership of that. That's important because that's the people that are governing this chain. So, getting responsible players that own Hash to contribute to the growth. This is crowdsourcing answers. So I would say custody is a big unsolved one. Humbly. Yep.
Custody is one answer. Carlos.
I think that what the industry lacks is real-world assets on chain, where you can do interesting stuff and new stuff. And any company building infrastructure to do that, I think that's where where most of the benefits is going to accrue. I think the last couple of years last 5 years was this theory of the the protocol level investing in layer 1 blockchains and tokens and stuff like that. I think that for the most part is solved. There's tons of L1s, some of them huge. I think the application layer of how you actually move these real-world assets on chain and everything.
Because these are going to be incredible.
Because that's a huge market, right? Like you're talking about trillions of dollars, and you're talking about new applications that do not exist today that you can enable with this technology.
JB.
Yeah, custody, of course. Regulated exchange as Bitstamp, of course. That's obvious. That's my short answer.
All right, that's a great show. And then finally, Greg.
I'd say startups that are technology-based, collateralization, credit-related, and digitization, like moving the TradFi and all the getting as much of the old players to bring flow into our sector.
Excellent. Well, thank you, panel. You guys were fantastic.
Yeah. Wow.
Really appreciate it.
1 second left.
That's David for you. Thank you very much, panel.